This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
June 2010, paper F7. I've got the exam in front of me. I'm in my 15 minutes reading time at the moment. So question 1, I'm not going to look at the figures, I'm just going to look at the requirement. Prepare the consolidated statement of financial position. And part B. Comment on the importance that we should attach to these consolidated financial statements when deciding on whether to grant credit terms to Trilby. Alright, 4 marks. We'll do that one first. Question 2 is income statement and financial position. Notes are not required. Statement of changes is not required. Alright, so it's a trial balance. It's not a set of draft financial statements. And there's a construction contract in there. Okay. Question 3. Prepare statement of cash flows using the indirect method as usual. Based on the information, advise the loan provider on the matters you would take into consideration when deciding whether to give Deltoid a renewal of its maturing loan note. So I can't do part A2 without having done part A1, but part B. On a separate matter, you've been asked to advise on an application for a loan to build an extension to a sports club which is a not-for-profit organisation. I've been provided with the audited financial statements for the sports club for the last 4 years. Identify and explain the ratios that you would calculate to assist in determining whether you would advise that the loan should be granted. So it looks like I'll be doing question 3B early on as well. Question 4, what on earth is this one? Substance over form. Describe the features that may indicate substance of a transaction may be different from legal form for 5 marks. Okay. All right. Assuming the above figures prove to be accurate, can I do the figures for 3 years, reflecting legal form and reflecting substance? Yeah. And comment on the effects of the two treatments have on the income statements. So I can't do part C without doing part B, but I could do 4A. I could plan that in my 15 minutes reading time. And finally, question 5. Borrowing costs. It's about time this was asked. Explain the circumstances when and the amount at which borrowing costs should be capitalised in accordance with IAS 23. Yeah, I can plan that one as well in my 15 minutes reading time. Calculate the net borrowing costs that should be capitalised as part of the cost of the new store, and the finance cost that should be reported in the income statement for the year ended 31st March. Okay, well let's have a look, see what we've got. Here we've got the plan, just written that out. Related party transactions, arm's length, freedom to operate, security, personal guarantees, comfort letters, call them what you want. Results of insolvent subsidiaries or loss-making subsidiaries will get hidden within the consolidated figures. Companies are separate entities, and therefore if you're lending credit or giving credit to Trilby, there's no responsibility for the parent company to accept that debt. Some F4 cases you may remember, Adams and Cape Industries, and of course Salomon and Salomon. Is there a legal obligation of the parent? No, there isn't. Now the question specifically says, comment on the importance when deciding whether to grant credit terms. I can't really get related party transactions, an arm's length and freedom to operate. That doesn't actually answer the question that's been asked. Comment on the importance that the parent should attach to the consolidated financial statements when deciding whether to grant credit terms. But I can bring all those 3 points in to the requirement, or what we should do is we should ask for Trilby's own financial statements, and even then we've got to adopt its healthy degree of professional scepticism because of the impact of related party transactions, the fact that Tradat may be imposing unrealistic trade terms on Trilby, and Trilby may not therefore be able freely to operate as they would want. So I've got there the basis of a plan for part 1B. Part 3, I've done a plan. Question 3, I should say. Question 3, I've done a plan. Question 3 asks for, let me find it. Identify and explain ratios I would calculate to assist in determining whether I would advise that a loan should be granted. This is for a not-for-profit organisation, as a sports club, looking for a loan to build an extension. My plan is going to say, look at 4 years to try to establish any trends. It's not for profit, but it will still have income in the form of member subscriptions, and it will still have expenses. So even though it's not for profit, there will still be the equivalent of an income statement. Liquidity ratios, the current ratio, not the quick ratio. I put the quick ratio there simply to present it to you and say, well, it doesn't really apply. Current ratios, again, doesn't particularly apply. What would be of greater importance surely is going to be things like interest cover and gearing, the borrowing compared with the accumulated fund of the members. I'd also want to look at the possibility of assets for security. The question doesn't actually give me room for that. It says identify and explain the ratios that I would calculate to assist in determining. But possibility of assets for security, whether assets have already been used, whether they're existing, whether there are existing assets pledged as security. And a trend of income in times of crisis may be one of the first things to go with sports club membership. So I'd want to be looking at the number of members over the 4 years and the ability of the sports club to increase membership fees over the period. Many of you, if not all of you, many of you have certainly been members of our club, and most yourselves have possibly thought about, do I continue to be a member? Is it worth it? Do I have the disposable income to spare? So that will be my plan for part 3B. 4A, an important aspect of the international stance. Explain why it's important that financial statements should reflect the substance of underlying transactions, and describe the features that may indicate the substance of a transaction may be different from its legal form. Well, this was my plan. Framework, fair reflection, fair presentation, substance over form. All of these are within the framework. All of these are specific elements identified within the framework. Fair presentation, fair reflection, economic reality. And the importance, why is it important? It's because of the users. They want certainty, they want reliability of financial statements, comparability. And these elements of the framework then, including substance over form, will help the stakeholder and global investor better to interpret the results, knowing that substance over form has been adhered to. And you see, the question is actually in 2 parts. And describe the features that may indicate that substance may be different. I've got unusual trade terms, risks and rewards of ownership, control, whether the company is now in control of the assets, or is the control somewhere else. And complex, the complexity of transactions may indicate that substance is different from legal form. And then question 5A. I've got a plan here as well for explain the circumstances when and the amount at which borrowing costs should be capitalised. I must be getting near the end of my 15 minutes planning time. And don't forget that all of these plans need to be replicated onto your answer book. All that I've written so far on the screen is within the question paper. I'm not allowed to write anything in the answer paper until after the 15-minute reading time is finished. So all of this on the screen needs to be replicated and put onto an answer booklet. Explain the circumstances when and the amount at which borrowing costs should be capitalised in accordance with IAS 23. Well, if it's borrowing money on a qualifying asset, the borrowing may be specific or general. If it's general, we need to apply weighted average principles. And a qualifying asset is an asset which is under construction, development, extension, and can include intangible assets. Intangibles. And then the amount at which borrowing costs should be capitalised. Circumstances when and amount at which. Capitalise at the effective rate of interest. It may be different from the apparent rate of interest, the actual rate of interest. But the effective rate of interest is the one that we would use. And we will start capitalising from when work has commenced on the qualifying asset, when work has started and the funds have been borrowed. So we might have started the work but not borrowed any money and therefore no borrowing costs. We might equally have borrowed money and not started, in which case we can't capitalise. So it's when work starts and funds have been borrowed, incurring costs. It should be net of any income from temporary investment. And we should cease to capitalise when the work ceases. For instance, the strikes, or work is stopped because of bad weather, or maybe because there's a national holiday for 2 weeks. So when work ceases, then we would cease to capitalise the borrowing costs. And stop when work is substantially complete. Now we may have a problem with substantially complete, but I don't think we do from a quick read of Part B. It was completed. The construction of the store commenced in May. It was completed and ready for use in February, but it didn't open until 1st of April. So 28th of February is the final date that we're going to capitalise. Calculate the net borrowing cost. So I've now planned, effectively, I've planned 20% worth of the paper, just about 4 lots of 5 marks. And that's within my 15 minutes worth of reading time. So now my question is, am I going to start with question 1 and get the big one out of the way, or shall I start with question 5 and get this small calculation out of the way? I've got 10 marks, 18 minutes, and I've just spent 3 minutes planning part A, 2.5 minutes planning part A. So that gives me 15 minutes to write out this and do the calculation.